And on today's show, how option trading works with an index annuity. Part 2 of this week's series on index annuities with nationally recognized annuity expert, Mike McGlothlin. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Well, welcome Mike, day 2.
Yeah, good to be back.
I'm glad you're back because we're trying to explain some baseline knowledge on index annuities so that we could all come to the table and agree and come. Because you do the same thing I do. I go out to Google and I see people talking about it. I'm going, that's not true. Mm-hmm. Yep. So I want to start talking a little bit today about the basics of option trading. Now, you've seen maybe 15, 20 carriers in their own home office. And you were just telling me you were with a carrier who has a complete floor of option trading. Tell me about that. That sounds outrageous. It's huge.
Yeah, they're large enough, and they also own some money managers, so they've combined that expertise of money management with the critical mass of premium dollars, and they've been able to do their own dynamic hedging. So there are a couple carriers that do that, one in particular that really has the art down to a science. And it really makes sometimes as much as a 40 to 50 basis points difference in your cap or spread rates because you're doing the hedging yourself. So
that outsource could be costly.
It could
if they're
be,
outsourcing this. Okay.
Yeah.
Well,
and the other thing is timing too. When you're doing a smaller amount, maybe you can only go to the market once or twice a month. And so some of your clients have money set in a fixed account for 2 weeks before they actually start indexing. So that's just another nuance there.
And are you saying then the people that have this in-house are doing this daily?
Yeah, they can do daily.
Wow, so there's power in that and there's some leverage.
Mm-hmm.
When I'm thinking about option trading, I kind of liken it, I hope maybe you like this allegory, hope you'll be okay with it. I'm looking for a home. Let's say I think I like this house, but I'm not really sure. So I'm going to rent it for a year, but I'm going to put a little bit more money down as an option to buy. Mm-hmm. At the end of the year, I noticed the appreciation of the home went up. The neighborhood's really great. I'm going to exercise my option to buy at that fixed price a year back.
Yep.
Or I don't like the neighborhood. The values actually went down. I don't really want to purchase the home, so I only lose my option. Is that a fair allegory?
I think that's a great analogy. I think there's a huge myth out in the industry with clients and with advisors that when you have a cap rate of 4% and the market does 6%, that there's a myth or a misunderstanding that the insurance company is keeping that 2% spread. The reality is somebody's keeping that. There's somebody that has bought the other side of that option from the carrier, but it's not the carrier participating in that. They're just buying from a protection standpoint at if the S&P was at 1,000 and they're buying that option at 1,040 to protect themselves from a cap standpoint.
Now, is that only for caps then? That would not be true in participation or spread?
Well, just different levers. But yeah, you're clearly going out and buying some type of option so that you can credit. But yeah, that's where interest rates play predominant part in more of a spread versus the option price on a cap rate. But yeah, I mean, the analogy stands over multiple crediting periods.
Well, I'm assuming that most of the annuities that not only that we play with, but that are the big dominant players in the market, that they've been exercising these options. I mean, the S&P alone, the S&P 500 has been huge for the last 5 years. So they're making this call. When I'm looking at the trading option from a client point of view, how much do I need to know about the mechanics to make a really good call as a consumer?
Well, I think what you need to understand is the carrier strength, and you also need to look, if possible, the renewal rate history. And a lot of firms are beginning to publish their renewal rates, not all of them. And we think that's a standard of a good, reputable company. These things have been out long enough that these have some renewal rate history, and you need to take a look at those in good times and in bad times, in volatile periods, in stable times, in high interest rate environments and low interest rates. How did that carrier perform, really? So yeah, I think that's one thing that you really need to take a look at.
And we've seen some carriers that have really good historical rates, and I like their ratings of the company. They're highly rated by S&P or AM Best. So those are some of your kind of like pre-qualifiers.
Yeah, absolutely, yeah.
Well, when I'm thinking about an option, I always think I'm always thinking about option trading in the floor as a regular client, as a regular consumer, and it seems so complicated. But really, in ours, the simplicity is they're pretty much investing whatever their bond portfolio interest rate return is on their actual holdings. Is there anything more to that? I think it's pretty straight up.
No, I think that's it. I think when you just need to take a look at really two different buckets. One bucket is their investment portfolio, which in today's interest rates have gone down. And so if a carrier is earning 4% on a $100,000 premium, they're earning $4,000. They're going to be paying expenses, commission, those types of operating expenses, and then whatever's left over, which is typically about a 2% spread for the cost and everything, the difference there would go to purchase an option or a spread. As interest rates change and as volatile pricing changes on the option, those are going to affect how much that the carrier can buy.
Now, if our carriers are outsourcing this, they're depending on somebody else to do this, as we said earlier, and some of our carriers have brought it in-house. Have you seen a distinction in that? Have you seen more an advantage for the people who actually are controlling this from the get-go?
Sure. When you take a look at that bucket of $4,000 that goes to expenses, and they have to commit some of those dollars to an option price, then that's just going to take the amount that actually goes to the actual option. So more expenses, less option means less return for the client.
So are these some of the mechanics that we can tell our advisors, here's what they're doing, so they can make a really knowledgeable choice?
It's a huge education to understand how these things work, and I think that a lot of registered reps are starting to get it by the growth that we've seen in the registered rep market.
So, and that's a very good point. We now have seen some migration from registered reps, securities, who are a little, I would say, cautious maybe would be a nice word to say. They were cautious, but now they understand it, they understand the mechanics, and they're now starting to come into it. They see this as a really good play for a conservative issue, don't they?
Yeah, absolutely. Once they understand the mechanics of it, but there's a lot of moving parts. It's not your simple sub-account and tax-deferred growth. There are some ups and downs and things like that, and some moving parts. You have to be comfortable with those and understand them and pick out the quality carriers. But once you get the concept, it's simplicity, conservative, fixed annuity with just a different way to credit interest. Once your client and the advisor gets comfortable with that, then we think that we have a good chance for success.
When we come back for the break, we're going to talk a little bit about the S&P 500. It's the vanguard of the entire indices, and we want to know, is that popularity really deserving? We'll come right back. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Welcome back to our second segment. We're with Mike McGlothlin, recognized for his annuity expertise. And Mike, we're even going to go a little bit deeper into your expertise. The S&P 500 index is the most popular, whether you're doing index annuities or whether you're doing index life or any index, even if you're just buying the S&P straight out from a fund, it's really popular. And maybe that's because everybody's familiar. It's an American, it's domestic, it's something that's been around forever, it's a name dropper. And when I look at the rest, there's so many other indices, foreign and domestic, but this occupies about 72% of all the index that's done. So is that deserved? Have they been doing really well?
Yeah, I think that it is deserved. It's not a function of return or anything like that. I think it's an issue of simplicity. The most successful FIA sales happen because a client is wanting to protect wealth. They want downside protection, but they want something that they can understand. And with the S&P 500, they can go to the paper and they can say, I purchased my fixed indexed annuity on June the 1st. And I can determine what that has done and if it's a positive increase. They can actually hand calculate out their return. And that simplicity gives a lot of comfort level from a sales standpoint as well.
Now, do they have the ability, because the S&P as a standalone fund is going to maybe have dividends, and dividends are not found in insurance products like index annuities or index life.
True.
So the mechanics, do you think that they understand that, and are we doing a good job to tell consumers that?
Well, I think we're doing a better job. Maybe 15 years ago, there's a lot of misunderstanding and some questionable sales practices, but I think the industry has cleaned that up quite a bit with all the suitability forms. And we're getting some advisors with registered reps in there that know the difference between the true S&P 500 fund and just linking to an index. And that advisor can differentiate between the two pretty easily.
Well, I'm looking at the Standard & Poor's 500 index, the S&P 500. What is that composite of? What is the client actually buying in his option?
Within the linking up to the S&P 500, what they are buying is a broad-based index, equity index. The S&P is a market-weighted index, meaning that those larger companies get more of their return calculated into the indices, so it's a little bit top-weighted. However, that can change over the course of time. Some companies drop out, some companies come in, some companies get a bigger share. But most importantly, you get a large, broad-based look at the market. In fact, many people say that the market is equivalent to the S&P 500 so that you can take a look at the general economic conditions. And again, that simplicity, the holistic look makes it nice and easy.
It's not there's not managed fees in this. It's just an index, right?
Exactly.
And the other issue is I've noticed many times when I went out to Google on the S&P 500, they call it the poor man's portfolio.
Yeah.
It's because like if you had to want to dip your toe into the market, you didn't know really pretty much what you were doing, this would be a good starting place. Would you agree with that?
Absolutely, because you get, if you're doing the Dow, you just get 30 companies. But with the S&P 500, you get 500 companies. And for those companies that are larger, your quote-unquote blue chips, then you're going to get more of a share of that versus the smaller mid-sized company that may be in the S&P 500. So it is a broad-based look, and for somebody that doesn't want to worry about asset allocation, that's a great tool to use.
Now, I've noticed that some advisors have brought up the issue of the VIX because it's tied directly to the S&P 500. It's kind of the volatility index. Does that help us when we're going in to sell, whether it's index annuity or index like this? Is that a helpful index to look at?
Well, I think that VIX explains a lot from a pricing standpoint. When you take a look at annual caps, the VIX, along with interest rates, are the two major components that affect pricing. So when you have a high VIX that is well over 17, 18%, then you have high volatility, and therefore your ability to buy more on the index through a cap is much less. So we really pay attention to the VIX from more of a pricing standpoint, but also clients just naturally feel volatility without even looking into a paper to see what the VIX is. They can feel it, they can see it in their other statements, and that brings up a conversation with their financial advisor or vice versa. They should be taking some gains off the table now that we've been on a great run. There's a lot of talk from the Fed about the complacency bubble and that we feel really good, but the reality is our economic conditions still aren't really solid foundation. And it's a great time to take some gains off the table, but still being linked on a broad index.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on the show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our site, downtobusiness.ashbrokerage.com. Want to email me? steve@downtobusiness.tv. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.